Well, there's been a lot of talk lately about whether selling your gold and silver has quietly turned into one of those ugly little tax traps that a whole lot of people don't fully understand until after the deal is already done. So in this video, we're going to separate noise from reality, and you are going to walk away a whole lot clearer on what can create a taxable event, what people in the metals world keep getting wrong, and why waiting until after you sell might be the most expensive mistake in the whole process. It is Sunday, April 12th in New York, so comment below with the day and date you're watching from. And real quick, if you value this kind of work, support the channel by subscribing and comment John A.G. Best. So I know you want more of these breakdowns. Because this issue right here, this is where people get blindsided. They think the danger only shows up when they sell for cash. They think the only thing that matters is whether some form shows up in the mail. They think that if no paperwork gets triggered on the other side, then maybe the transaction just kind of disappears into the fog and never becomes anybody's problem. And I'm telling you right now, that kind of thinking is exactly how people wander into a tax mess with a smile on their face. Now, I get why the confusion exists. A lot of people in the physical metals world still think in a very old school way. Local shop, coin show, handshake, cash deal, trade one thing for another. No brokerage app, no blinking screen, no fancy statement. And because the market feels more tangible, more private, more grounded in the real world, people start assuming the tax rules must be looser too. That's the emotional logic. But emotional logic and tax logic are not the same thing. And that gap matters more now than it used to. Because after the kind of move gold and silver have had, there are a lot more people sitting on gains than they were a few years ago. Gold didn't just drift higher. It smashed through wave after wave of new highs last year. Silver had a huge run of its own and turned back into one of the most emotionally charged trades in the market. So now more stackers are tempted to trim, more investors are tempted to rotate, and more people are tempted to play the gold-silver ratio without really thinking through what the government may call that transaction on paper. That's the setup. Now here's the first hard truth. When you sell precious metals, you are generally entering taxable event territory. That does not mean every transaction gets reported the exact same way. That does not mean every product is treated the exact same way. That does not mean the same forms appear in every case. But the big idea is still the big idea. Selling is not magically invisible just because it happened in the physical world. Question 1. Was there a taxable event? Question 2. Was someone else required to file an information report about the transaction? Question 3. Will the government actually know about it right away? Those are not the same question, not even close. And if you blur them together, you can talk yourself into a very comfortable mistake. For example, a lot of people think like this. If I don't get the form, then there must not be tax. No form, no problem. End of story. That is not a serious way to think about it, because the absence of a form does not magically erase the gain. The reporting issue and the taxability issue overlap sometimes, but they are not the same thing. In fact, current IRS material now makes clear that many precious metals sales are not reportable on Form 1099-B unless the metal's form and quantity line up with what regulated futures contracts can actually accept. But that reporting carve-out does not automatically wipe away any tax question for the seller. It just means the paperwork side and the tax side are not identical. Because once people hear that not every sale is reportable the same way, they jump to the lazy conclusion that maybe none of it matters. No, a reporting form has limits. Your tax responsibilities can still exist. Those two statements can both be true at the same time. And this is where another old metals world belief starts to fall apart. For years, people carried around the idea that certain metal-for-metal swaps somehow floated above taxation. One kind of gold into another kind of gold. Bullion into numismatic. Gold into silver. Silver into gold. No cash changed hands, so maybe there was no taxable event. That kind of thinking stuck around a long time. But after the tax law changes that applied for years after 2017, like-kind exchange treatment was narrowed to real property, not personal property. And IRS guidance says Section 1031 now applies only to exchanges of real property, while IRS publication material still defines an exchange of property for other property as a disposition that can create gain or loss. In plain English, that old shortcut people used for precious metal swaps is not the safety blanket they think it is. That's where the pain starts. Because people love ratio trades. They absolutely love them. Gold feels expensive, silver feels cheap, they rotate, silver runs hot, gold feels steadier, they rotate back. From a strategy standpoint, I understand the appeal. From a tax standpoint, you need to slow down. Because a swap can still be treated as giving up one asset and taking in another. And if you gave up appreciated property, the math may still matter even if you never touched cash. That is exactly why some people end up furious when they realize that staying inside hard assets does not necessarily keep them outside tax consequences. And I get why that feels crazy. You're thinking, hold on, I didn't cash out into dollars. I didn't go buy a truck. I didn't go take a vacation. I stayed in metals. I just moved from one side of the ratio to the other, right? But the system can still look at that as a disposition. That is the lens. Now let's talk about the word that makes all of this real, basis, because it's easy to sound confident when you're talking about your stack in broad terms. It is a lot less fun when somebody says, great, tell me exactly what you paid, when you paid it, and what records support the number you plan to report. That's when the confidence gets quiet. IRS guidance on basis is very plain. Basis is generally what you paid for the asset, and you use it to figure gain or loss when you sell, exchange, or otherwise dispose of property. IRS publications also stress that you need accurate records for basis. That sounds simple when you say it quickly, but in the real metals world, it gets messy fast. Because let's be honest about how a lot of this market actually works. Some people have perfect records, folders, spreadsheets, dealer invoices, shipping confirmations, photos, bank records, the whole thing. Beautiful, but a whole lot of people do not live like that. They bought over time. They bought from different places, some online, some at local shops, some at coin shows, some maybe from another collector, some maybe in cash, some maybe with a paper slip that disappeared years ago, some maybe with a memory and not much else. And now the metal is worth a lot more. Now they're thinking about selling. Now they realize there is a huge difference between knowing you bought something a long time ago and proving what you paid for it. That gap is where the real stress lives. Suppose you bought a gold coin years back when prices were dramatically lower than they are now. You sell it today at current market levels, maybe even a little under the hottest quote because you're taking a dealer bid. You still may be sitting on a gain relative to your cost. Fine. But then comes the ugly question. How do you know the exact basis you're supposed to use? Do you estimate? Do you reconstruct? Do you look at bank statements? Do you search old emails? Do you call the dealer? Do you lean on whatever receipt survived? Do you use historical records to build a reasonable picture? Those are not casual questions, because in an audit, I guessed, is not a strategy. And here's where people make another bad leap. They say, well, what if I bought at a coin show? What if I sold peer-to-peer? What if it was a local cash deal? What if there's almost no paper? How are they going to know? Now look, that is a practical question, but notice how quickly people slide from this may be harder to trace to therefore the obligation must not exist. Those are not the same thing. Difficulty of enforcement and absence of legal obligation are not the same thing. That is the hinge point for this whole conversation. Now, I also want to challenge one of the loudest emotional arguments in this entire space, because this is where people start mixing valid frustration with sloppy conclusions. They say the whole thing is immoral because the government taxes paper gains while inflation wrecks the dollar. And on a human level, I understand the anger. If the currency lost purchasing power while your metal rose, then part of what looks like a gain may just be the measuring stick getting weaker. That may be a fair philosophical complaint, but it is not the same thing as a filing rule. The tax code generally is not giving ordinary investors some broad inflation adjustment on gains from selling appreciated property. That's why the paper gain complaint feels powerful emotionally while still failing as a compliance strategy. You can hate the rule and still have to plan around the rule. And this goes well beyond metals. If a saver earns a weak nominal return while inflation is stronger, that saver can still owe tax on the nominal return. People hate that too. I get it. But the government is not usually asking whether the gain felt spiritually satisfying. It is asking what the return says, what the basis was, how long the property was held, and what the law does with that result. Now, before we go any further, I want to push back on another thing that gets repeated way too loosely online, the magic threshold myth. You know the one. People say, oh, if it's under this amount, you're fine. If it's over that amount, now it matters. One neat little number solves everything. Be careful there. Because a lot of people are mixing up different forms, different years, different reporting systems, and different transaction types. The broader reporting world has already changed multiple times recently. For example, IRS FAQs now say the old Form 1099K threshold was retroactively restored, so third-party settlement organizations generally are not required to file unless payments exceed $20,000 in more than 200 transactions. That alone should tell you how dangerous it is to build your metals plan around one viral threshold number somebody repeated online. It means you need to know which threshold belongs to which form, which year, and which type of transaction. Now let's go back to the metals market itself, because this is where the script needs fresh context, not stale talking points from a year ago. Gold had an extraordinary year. According to major industry research, the benchmark price set more than 50 new all-time highs during 2025, with the annual average and fourth quarter average both reaching records. At the same time, recent Reuters coverage shows spot gold still trading at historically elevated levels in early April, supported by dollar weakness and geopolitical stress. So this is not some sleepy market where hardly anybody has gains to think about. A lot of people do. Silver has its own story. And silver's story may be even more emotional because silver holders tend to think in terms of squeezes, deficits, ratio moves, and upside explosions. Industry Outlook material for 2026 says the silver market is expected to remain in deficit for a sixth straight year, with physical investment rebounding and macro uncertainty still supporting interest in the metal. That means more people are likely to keep rotating into silver, more people are likely to trade around silver volatility, and more people are going to wander into taxable events thinking they were just making a clever move inside the metals universe. That's why this topic matters more now, not less. Because the stronger the run, the more relevant the tax conversation becomes. Official-looking products do not automatically get wrapped in a magical tax-free flag just because they feel patriotic or monetary. A lot of casual chatter treats government-minted bullion like it must be exempt in some broad sense. That assumption is way too loose. Now I want to make one more point about holding periods, because this is another area where people speak in fragments and then act like they have the whole map. Precious metals can fall into collectibles treatment in certain situations, and current IRS topic material says net capital gains from selling collectibles such as coins or art are taxed at a maximum 28% rate. IRS investment publication material goes further and specifically lists metals such as gold, silver, and platinum bullion among collectibles when held more than 1 year. That does not mean every conversation about tax rates can be compressed into one sentence, but it absolutely means metals holders should stop assuming they will automatically be taxed like ordinary long-term stock gains. That one catches a lot of people off guard, because they think, well, I held it long-term, so I'm golden. Maybe not in the way you think. This is exactly why you do not want to learn your tax position from a guy in a comment section who sounds confident and owns a tube of Eagles. Now let's get practical. What should a serious metals holder actually do with all this? First, stop thinking about taxes only when you are ready to sell. That is backward. Tax planning starts before the transaction, not after it. If you wait until the deal is already done, a lot of your options are gone and a lot of your uncertainty is locked in. Second, get your records together before you need them. Not next year, not eventually, now. Receipts, invoices, trade confirmations, dealer emails, shipping records, photos, payment records, anything that helps support basis and timing. If you're successful, share your success story in the comments so others can stay motivated. Because honestly, one of the most underrated flexes in the metals world is not the giant stack photo. It is the boring little folder that keeps you out of trouble when the giant stack photo turns into a taxable event. Third, do not assume a swap is harmless just because no dollars touched your hand. That thinking is outdated. Fourth, if you hold metals through a retirement structure, do not rely on loose internet simplifications. Eligible metals, custody arrangements, and account rules matter a lot. In fact, IRS retirement plan material still warns that investments in collectibles inside qualified accounts can trigger very specific consequences, which should tell you right away that retirement treatment is detail-heavy, not something to summarize with one lazy sentence. Fifth, separate your opinions from your obligations. One more thing, and this is important. Do not confuse talking to a professional with handing them a pile of chaos and hoping they can perform magic. A good tax advisor is not a time machine. They can help you classify the transaction, explain the rules, and tell you how to report it, but they still need facts. They still need dates. They still need records. They still need a basis story that is grounded in something better than a shrug. So when people say, "I'll just ask my accountant later," later is doing a lot of work in that sentence. Later can be expensive, later can be stressful, later can leave you recreating years of activity under deadline pressure. Much better to prepare before the transaction and use professional advice as a check on your plan, not a rescue mission after the smoke clears for your situation specifically. You may think the system is unfair. You may think inflation makes the gain feel fake. You may think the whole thing is ridiculous. Fine, but your opinion about fairness does not change the return you have to defend. That's the truth. Now, I also want to spend a minute on jewelry, because this is another corner of the story people underestimate. For years, a lot of personal jewelry sales never felt like tax stories at all, because many people sold for disappointing bids compared with what they originally paid at retail. The spread was bad, the resale value was soft, and the whole thing felt more like liquidation than profit-taking. But once gold and silver move high enough, the math can change. Suddenly, that old chain, that bracelet, that set of inherited pieces, that box sitting in a drawer for years, starts drawing serious offers. And now somebody who never once thought of themselves as an investor may still have to think about gain, basis, and records. Not because they were trading charts all day, but because the underlying metal got strong enough to make the sale matter. Inherited metals can get messy too. Gifted metals can get messy too. Collector pieces can get messier than standard bullion, because now you may have metal value mixed together with scarcity value and collector premium. The more complicated the item gets, the more careful you have to be about assuming you understand the tax side just because you understand the hobby side. There is also a major difference between an individual holder and an actual business. If a dealer is moving inventory in the ordinary course of business, that is a different posture from a private person selling part of a long-term stack or unloading personal items. Same metal, different framework. So you never want to copy somebody else's assumptions just because they also buy and sell gold and silver. Their structure may be different. Their record keeping may be different. Their reporting may be different. Their whole situation may be different. Let's also come back to the reporting piece for a moment, because I think this is where a lot of people hear half of a fact and then build a whole fantasy around it. The recent IRS correction on precious metals reporting did not say all precious metals sales are invisible. It said sales are not reportable on that form when the metals form is not approved for regulated futures trading, and even when the form is approved, sales below the minimum futures contract quantity are still not reportable for that purpose. Sales for one customer inside a 24-hour period are supposed to be aggregated for that test, and the exception does not apply if someone is breaking sales up to avoid reporting. That is a very specific reporting rule. It is not a giant nothing matters stamp for metals holders. People sometimes think physical markets are quirky enough that the paperwork side must still be frozen in some earlier era. That is not really the world we live in anymore. Dealers are more systematized. More payments leave trails. More communications leave trails. More records can be found later than people assume. Now let's talk about records in a more constructive way, because a lot of people hear, keep records, and then shrug like that advice is too generic to be useful. It is not generic if you get specific. You want a simple system. A folder by year, a folder by dealer, scanned receipts, photos of paper slips, notes on show floor trades, screenshots of messages if the deal was arranged privately, copies of shipping labels, copies of checks, bank movements tied to purchases and sales. Even a clean spreadsheet that matches dates, products, quantities, and prices can help you reconstruct a story later. You do not need a museum archive. You need something that future you can actually understand when future you is under pressure. That matters, because the worst time to become an amateur detective is after you already sold. And I know some of you are thinking, okay, but what if the records are already missing? What if the receipts are gone? What if the shop closed? What if the deal happened years ago? You may still be able to rebuild part of the trail with bank records, emails, old text threads, dealer history, archived order accounts, photos, insurance schedules, or even shipping confirmations. But the quality of reconstruction usually gets worse as time goes on. Memory fades, businesses change systems. Email accounts get deleted, people move, old phones disappear. So every month you wait to organize the evidence you do have is basically a bet against your future clarity. Not a great bet. When metals are ripping, people stop thinking carefully. Gold making new highs creates urgency. Silver volatility creates urgency. Ratio opportunities create urgency. Suddenly everybody wants to act now and clean up the details later. That instinct is understandable, but it is exactly backwards. And recent market context is a perfect example of that. Gold's 2025 run was not some minor move. Industry research described record annual demand and a year full of repeated all-time highs. Silver's outlook heading into 2026 still points to structural deficit conditions and stronger physical investment after a monster price run. Those are exactly the conditions that tempt people into action. And action is where tax planning either saves you or ambushes you. A lot of people care deeply about whether a rule is fair, constitutional, immoral, ridiculous, whatever word they want to use. I understand that. But if your practical preparation is weak, being emotionally right about inflation or philosophically right about sound money does not solve the filing problem. So if you want the one-sentence version of this entire video, here it is. Do not let your conviction about gold and silver blind you to the administrative reality of owning, trading, and selling them. That is the warning. Not never sell. Not the IRS sees every coin. Not every swap is instant disaster. The warning is simpler. Do not drift into a taxable event without understanding the map. And if you take that seriously, then this topic goes from scary to manageable. Maybe still annoying. Maybe still unfair in places. Maybe still a headache. But manageable. That is what we want. We want clarity. Because clarity is what lets you keep your strategy intact while avoiding stupid mistakes that have nothing to do with whether you were bullish on metals in the first place. Now let me give you the skeptical counterpoint, because I don't think fear merchants have this exactly right either. Some people in the metals world talk as if every sale, every swap, every show floor conversation is basically a guaranteed catastrophe waiting to happen. I don't buy that framing. Yes, the rules matter. Yes, swaps can count. Yes, basis matters. Yes, records matter. But no, that does not mean every metals holder is doomed the moment they think about selling a coin. A lot of the fear comes from confusion, not just from the rules themselves. If you keep decent records, understand what you own, know when you bought it, know whether you are selling or exchanging, know whether you are dealing inside a qualified account, and get competent tax advice before making a meaningful move, this becomes more manageable than the doom crowd makes it sound. Still annoying? Absolutely. Still survivable? Very much so. The real danger zone is lazy certainty. It's the guy who heard one thing 5 years ago and never updated his thinking. The guy who assumes the form is the whole law. The guy who thinks official bullion must be exempt because that feels right. The guy who swaps gold into silver and calls it a non-event because no cash hit his pocket. The guy with no records who plans to solve that problem with confidence. And it gets even more relevant because the market itself is maturing in strange ways. More institutional attention, more futures activity, more retail curiosity after huge price moves, more interest in smaller products, collectible products, and strategic ratio trading. Meanwhile, the physical side still has that old school texture: local coin shops, private deals, coin shows, inherited items, jewelry, bars, rounds, semi-numismatic pieces, and collector coins all living in the same messy ecosystem. But confusion is not a defense. Preparation is. So before you sell, before you trade, before you upgrade, before you unload jewelry because the bid suddenly looks attractive, before you play the ratio because silver feels cheap against gold, ask the adult questions first. What exactly is my basis? What records support it? What is my holding period? Am I selling or exchanging? What kind of property is this? What kind of account is this? What assumptions am I making that I have not actually verified? And one last warning here. Do not let the existence of taxes bully you into abandoning a good investment plan. That is another mistake. Some people get so spooked by the tax angle that they freeze. They stop evaluating opportunity cost. They stop thinking in after-tax terms. They stop asking whether the move still makes sense after the consequences are estimated. They stop distinguishing between a painful tax bill and a bad financial decision. The better approach is simple. Know the rules, estimate the consequences, compare the alternatives, then make the best decision with your eyes open. That is how grown investors move. Not by pretending taxes do not exist, not by assuming they are impossible to navigate, and not by waiting until filing season is staring them in the face and then scrambling to reconstruct what happened years ago at a coin show. That is the movie you do not want to be in. So the big takeaway is this: selling gold and silver can create tax consequences. Exchanging gold and silver can create tax consequences. Missing paperwork can turn a manageable issue into a miserable one. No form does not automatically mean no tax. A threshold rumor is not a strategy. Inflation may make the gain feel less real, but that feeling does not rewrite the rules. And the best move is to think through all of this before the transaction, not after. That is the game. And the people who respect that game usually sleep a lot better. Drop your thoughts below, especially if you have dealt with basis headaches, old coin show purchases, local shop records, inherited metals, or metal-for-metal swaps, because the practical side of this is where people learn the most from each other. And just remember, this video is here to help you think more clearly and ask better questions. It is for education only, not personal financial or tax advice. And before you make a move with your metals, run your exact situation by a qualified professional who can see the full picture you are actually dealing with.